George, thank you very much for the introduction. Let me thank Nicholas for the opportunity given to us to present this panel. My name is Vartzis. I'm a partner at Stephenson, Harwood, based in the Piraeus office, and I specialize in ship finance. I've been asked by Nicholas to moderate this panel, which I think is going to build up from the previous panel, concentrating on capital markets and equity, private equity. However, because of the nature of the panel discussion, I think that we should cover some aspects of alternative financing in light of the fact that there is scarcity of traditional bank lending and how this vacuum is actually being filled in by alternative means of financing, including capital markets and private funding. I've got Mark and Stefanos next to me, quite well known in the market, especially Stefanos has been in the banking sector for a considerable period of time, acting for a bank, and also Mark has has flown from New York in order to attend this panel discussion. As we all know, as we are all active in shipping is becoming more and more professionalized, regulated, and complex. All these features, in conjunction with the fact that there is high volatility, has recently resulted in a dramatic slowdown in traditional bank lending, which has been encountered over the last year or so. In particular, the regulatory challenges which have come across over the last couple of years, affecting the way banks operate and assess risk, and I'm referring, of course, to Basel IV, IMO 2020 and CRS, have admittedly created a financing void for the medium and small size shipping groups. However, these circumstances I have just described have at the same time rendered shipping much more attractive and sexy, if I may use this term, for investors, as a result of which new players have penetrated the market trying to provide capital to shipping players. And I'm referring, of course, to capital markets, different platforms that have emerged over the recent period, stock listings, export credit, and lease arrangements. We have established the slowdown of traditional banking, and this point has been covered by the previous panelists, but I would like to get an input from someone from the other side of the river, actually. So I would like to set the first question to Stefanos. Stefanos, do you see the current slowdown in the traditional banking lending continuing? And what are the main reasons, in your view, these are that have resulted in this slowdown? Thank you very much.
Thank you, Chris. I think traditional bank financing is coming in and out. Is coming in and out in various phases, driven by new pieces of regulation coming in, or a major audit kicking in and the aftermath of that, or several other factors that have to do with the cyclicality of shipping. So, in response to that, banks have indeed been withdrawing from the small to medium-sized shipping companies, and instead they've been focusing more and more on the larger institutional corporates. The main reasons for that is obviously regulation, and the other is perhaps mispricing of risk-reward, which has led to unfortunate decisions having been made and losses occurring. So these are the main aspects that have led to the withdrawal of traditional funding from the medium to smaller sized companies. Now, volatility in shipping is attractive to a large array of investors, and we see that through our platforms. So that's the good news. And it is a matter of really deploying and putting to work all that alternative pockets of finance and acting responsibly in producing ship financing loans that are adequately priced at a decent point in the cycle offered to those investors. So acting prudently without having to have a regulator on top of our heads. And that's a responsibility across all platforms.
Yeah, that differentiates the position, I think, between traditional lender and yourselves. However, do you consider that the factors affecting traditional banking resulting in this slowdown may change in the near future? Or do you think that that banks will be facing this sort of regime for the foreseeable future?
I think regulation is there to stay. It's only going to steepen. And also to the first part of your question, it's a matter of whether the banks want to move away from that concept. And I don't think they are, or they are not prepared to do that as of yet. If that changes, there are ways to achieve that. The banks have the tools, the means, the platform, the people to manage any kind of risk-reward bracket, and not just the larger corporates, lower risk-reward transactions. They could use their technology. They could use technology. They could deploy their platforms to attract different pockets of capital that are prepared to take a little bit more risk and differentiate themselves than the usual traditional bank lending.
Thank you very much, Stefan. Mark, do you see a trend for the transfer of the activity, a geographical shift from Europe towards the US, or more admittedly towards Asia?
Thanks for the question, and thank you for asking me to participate, Nicholas. And always great to come to this conference because you have the most enthusiastic attendees of any conference that I attend, and you also have a group of owners here that are really dedicated to make this market special. So I'm delighted to participate. In terms of where are the new lenders, maybe at the margin they're in the U.S. and we'll talk a little bit about the hedge funds, though they're really not a major part of the lending market. I sort of think of them on the margin. And you recently saw a bank called Beal Bank, which I don't think many of us recognized beforehand, providing the lending to Nordic American tankers. So yes, there may be some additional activity in North America, but it really is the Asian lending community doing the sale-leasebacks that is providing significant dollars to the industry at this point.
Thank you very much, Mark. This reduced appetite from the traditional banks for the shipping sector that has created opportunities for other players. How do you see the alternative sources of financing progressing in the worldwide market of shipping from different perspectives, lease structures, capital markets?
Well, maybe instead of being so technical, let's sort of step back a little bit. What's been I could actually argue to Paulus's point about 80% lending at $80 million, while that may have been attractive to the entity that got the money at that point in time, I actually think it's that type of activity led to a lot of the oversupply that we have in the industry. So although no individual owner right now wants to be searching for capital or spending more for capital, I actually view this as the real silver lining in the industry right now, that capital is really hard to get unless you're a very differentiated owner. And I've spent a lot of time in this business, and the nice part about the industry is it's very entrepreneurial, and everyone wants to grow. The problem is when everyone wants to grow, you have too much supply. So although we can all bemoan the lack of financing, if everyone had to just cash finance out of their own proceeds, money for new projects, you'd see remarkably higher returns in the space. So maybe we should be have less angst about the lack of capital and actually, to some degree, celebrate it. So those that are landing, aside from the relationship banks, and I thought the previous panel was sort of spot on in terms of where the bank market is. It is there for sort of the top tier lenders. You know, the returns for that lending is probably, you know, not so great, but they do it as a matter of relationship. For those entities, whether it's private equity firms or hedge funds or, you know, whatever we want to call the alternative lenders, you know, they're going to lend where they're going to, you know, get something greater than their cost of capital, and their cost of capital is considerably higher than bank cost of capital. So for those that need to access that market, you're going to be accessing it, you know, at rates that may be, you know, 2 to 3 times the LIBOR margin that, you know, most folks that have traditionally borrowed. It's, you know, a much different game.
Yeah, thank you very much, Mark. Stephanie, how do you see the development of platforms in the shipping sector? This is something new that, and you know, platforms have emerged in the shipping sector. How do they usually operate, and how your platform, YieldStreet, is differentiated from the other platforms? If you could give your insight on this, please.
Sure. So it is evident that in the past few years, there are more and more alternative lending platforms out there that have emerged, and they've operated over the past at least 2 to 5 years. So there's already a track record in saying that this is an instrument that has been around, is growing in terms of significance, and is there obviously to fill a gap in the industry, which is, you know, those smaller to medium-sized companies and perhaps mid-aged vessels that traditional banks are not really there to service, other than a few core relationships of the past. So what we do differently in that space, and that space is starting to become even crowded, I would say, is that we deploy technology in bringing together hundreds of thousands of individual persons, individual investors that are our subscribers. For the time being, these are US accredited investors, and offering them asset-backed investments in, you know, commercial, real estate, and in ship financing. Now, what that means to the ship owner is that the ship owner does not have to worry about YieldStreet being able to raise money first before making that facility, that loan facility available to them. YieldStreet underwrites and funds the loan through its own resources, and thereafter launches that product, that loan facility, to its members and invites them to take a smaller or larger stake in it. And that's how we work.
It's an interesting structure. Thank you, Stephanie. Moving on to the listed companies, Mark, how do you see the existing listing companies doing in the next half-year period? And do you consider that the capital markets can support further stock listings in the shipping sector in the near future? Because I do get the feeling that investors are quite reluctant in investing in shipping industry.
Well, I would say to your second question, that's a pretty quick answer. That would be no. You know, unless, you know, something incredibly differentiated came to market, which is possible. Maybe there's, you know, some incredibly well-sponsored, you know, LNG vehicle or something that really sort of looked and felt very different, had low leverage. You'd need to come up with a lot of amazing attributes for new investors to fund that. And, you know, the biggest challenge right now when you look at the valuations is, you know, by and large, everything is trading well below net asset value. So I think you'd be hard pressed as an owner to want to actually do a listing now. In answer to your former question, we've been incredibly active in the M&A market over the last few years. I would say right now, by and large, companies are much more internally focused than we've seen them in some period of time. Look, there's always an opportunity. There's benefits to scale, certainly from a equity capital market perspective. Investors do want more liquidity. In general, they're looking for, you know, larger entities. However, I think we're in that period where we're most sectors are trading at, with fairly low freight rates. You have a lot of new regulatory questions. We don't need to belabor those, but I think all those things sort of contribute to a little bit more of an internal focus right now. And in addition to just if something required, significant financing, I think it's just a much more challenging moment to either, raise new capital as part of an acquisition, or if you had to refi existing obligations of a target, that would be challenging. So it's, sometimes we as advisors can do really well even when the industry is struggling. I think right now, advisors are, sort of struggling to, find a lot of places where they can be impactful, sadly as that is.
Yeah, that's a fair comment. And moving on to the private equity opportunities, do you think that private equity opportunities do look better in comparison to the capital markets?
I sound like a real downer, I'm sure. I'm usually a glass half full guy, but perhaps it's half empty. What we've learned, and look, anyone who's invested in shipping largely over the last 5 to 10 years, unless you really were nimble as a trader, have lost money. We saw a lot of private equity guys come into the space, and they have no more magic than owners or individual investors. By and large, they've taken their lumps as well. And so I think they've also found out that there's not great liquidity in the space. So it's, the so-called Hotel California, where, getting out is more difficult than getting in. So what have they learned from that? I think a little bit of what they learned is maybe it's easier to be a lender than an equity owner, because the good thing about a loan is it either gets paid back or you get the asset. Hopefully it gets paid back. So, but at least there's specific maturities and amortization along the way. So, a private equity guy, the first thing they do after they buy the asset is they're trying to figure out what their exit is. So at least in the lending context, it's a little easier.
And I'd like to set my last question. I think that question was set to Lenny Bretou earlier, talking about restructuring and distressed situations. Lenny has presented to you representing a traditional bank. I would like to get the insight, the input from a different perspective, and I would like to get Stefanos' view. How do you see, or what do you expect the alternative means of financing, or a platform, for example? How would the platform approach a distressed situation? Would they look into that in a more amicable, trying to resolve the issue without enforcing, without foreclosure, or there are other parameters that have to be taken into consideration before they decide how they will approach the distressed situation? I think that's an interesting point of view.
I think that this really depends on a number of aspects. One being the structure of that fund or that platform, and how many stakeholders are there, and what kind of discretion the management has to resolve the situation without having to refer back to a large number of investors or a smaller number of investors. The second aspect is strategy. So short-term cut losses go, or longer-term, staying in the game, work together with a ship owner and create a win-win situation. Another aspect that may be of significance is also the team that is dealing with the issue, whether there is thinking out of the box, whether there is creativity in the sense of avoiding what has caused a lot of trouble in the past, being kicking the can down the road, and actually recognizing the realities and dealing with them in a constructive and creative way. So, perhaps convert part of a problem loan in equity, get some upside there as lender, get a profit share. All those things will play a role in resolving the situation. I don't think that all funds that are regarded as being aggressive really are as aggressive as they are perceived. At the end of the day, they are there to protect their the money of the principals. So they are clever enough to recognize that working together with a ship owner delivers best and optimal results.
Thank you, Stefano. Was there a question?
Yes, okay. No, I just wanted to mention, since we're not going out memory lane, but since we're closing the session on ship finance and equity finance, I just want to send a short reminder as to the scandalous KG error. I call it scandalous because that's the understatement. Commerzbank, Deutsche Bank, I don't know how many billions of dollars they lost. I don't know what damage they did in the market, the shipping market, by actually ordering ships superfluous over this indiscriminately without any thought or foresight. And I think basically to bridge the gap that shipping, even as I said, being traditional shipping, in the shipping business myself, I think if you maintain the traditional shipping values and also the banking facilities, if you maintain traditional banking facilities in terms of not trying to over leverage on the high market, as Vartzis mentioned earlier, there's no point in having a $60, $70 million ship and thinking about going haywire by lending 80%, 70%. But maybe you want to be a bit more flexible when there's downside of the market, when there's hardly any cash flow, when you've got $500,000 or $1 million worth of negative cash flow. That might be a good opportunity to go and sit back a bit more imaginative, a bit more dynamic in your lending. But I think one big lesson I think we all learned, and I don't think anybody suffered firsthand at least, is I think, as I say, it's just about the old scar tissue, which you always remember, the KG companies. The KG system, where I think it was the most scandalous, outrageous form of financing ever which occurred in the history of shipping. And we should put this up and down as a footnote. Thank you.
Any questions from the floor, the panel? Thank you very much.
Okay, thank you everybody.